All right, let's dive right in and crack open the case file on a company we all think we know, PepsiCo. It's an absolute giant, a staple in our lives, and it feels like an unshakable fortress in the market. But the big question is that fortress really worth the price of admission? Let's follow the evidence and find out. I mean, seriously, from the corner store to the Super Bowl, their brands are just everywhere. I'd be willing to bet you have at least one of their products in your kitchen right this second. It just feels like one of the safest, most predictable companies on the entire planet. And at the time of this analysis, the market put a very specific price tag on that feeling of safety. One share of PepsiCo would set you back $143. Okay, so that's our starting point. And that is the billion-dollar question, isn't it? Is the price you pay the same as the value you actually get? We're going to investigate that by following the trail of one analyst's deep dive to see if this company can meet their goal for long-term returns. So, first things first. To figure out its real value, we need to understand exactly what it is we're buying, what's actually inside this PepsiCo fortress. And right away, we find our first major clue. Even though the name is Pepsi, the reality is that it's a 50-50 business. About half its money comes from drinks, sure, but the other half comes from snacks. In fact, the analysis calls Frito-Lay the company's true economic engine. So this isn't just a soda company, it's a full-on snack food empire. You know, every great fortress has a moat to keep invaders out. And in the world of business, a moat is just that, a competitive advantage that protects a company's profits from rivals. So just how deep is PepsiCo's moat? Well, according to this source, it's built on 4 massive pillars. First, brand ubiquity. Their names are literally everywhere. Then, massive scale. They make things so cheaply that it's almost impossible for anyone to compete on price. You've got distribution dominance. Their trucks are on every highway. And finally, shelf space control. Retailers basically need them to fill the aisles. I mean, good luck to any newcomer trying to challenge that. And that diversified strength is what really sets them apart. Think about it. Coca-Cola is the king of beverages. Companies like Mondelez and Nestle are huge in snacks. But PepsiCo, they're this rare beast that has a foot planted firmly in both worlds. And that unique position is a huge part of their power. Okay, so we get it. It's a beast of a company with huge strengths. Now for the fun part. Let's see how the analyst translates all of that into an actual dollar figure. It's time to talk numbers and find out what this thing is truly worth. But before we reveal the number, we need to quickly get on the same page with this key concept, intrinsic value. It sounds fancy, but it's simple. Think of it as the detective's estimate of what the company is worth based on cold, hard evidence, like its cash flow and earnings, completely separate from the emotional price tag the market might slap on it day to day. And here it is. After running all the numbers, looking at the cash flows and the earnings, the analyst calculates an average intrinsic value of $111.50 per share. Now remember that market price we started with? Let's put those two side by side. Wow, this chart really says it all, doesn't it? The market price is way up at $143, but the analyst's calculated value is down around $111. The crucial point here, based on this analysis, is that investors are paying a hefty premium for PepsiCo's stock. Now, paying a high price for a great company isn't always a bad thing, but a good investigator always looks for cracks in the walls. So what are the potential risks that could challenge this fortress? Well, the first red flag that pops up is debt. A lot of it. The analysis points to a debt-to-equity ratio of 2.62. To put that in plain English, for every single dollar of its own money, the company has borrowed over $2.60. For a company that's supposed to be super stable, that's pretty high, and it just reduces their flexibility if the economy ever gets tough. And the analyst's full scan shows a few more areas to keep an eye on. That rising debt is flagged as a moderate risk. And that amazing moat we talked about, it's not crumbling, but there's a slow erosion happening, which is definitely a pressure to watch over time. And here's another key piece of evidence. The company is actually getting less profitable. Its profit margins, basically the amount of profit it squeezes from every dollar in sales, have fallen. The 10-year average was over 10%. Today, it's under 8%. That suggests that costs are rising and it's getting harder for them to make a buck. So let's bring it all together. We have an incredibly powerful company with a super wide moat, but it's trading at a really high price, and it's starting to show some financial red flags. So what's the final verdict? I love this quote from the source because I think it just perfectly nails the situation. PepsiCo is a fortress priced like a luxury asset. It's so true. You're buying something strong and dependable, a fortress, but you're paying the kind of price you would for a rare, high-end luxury good. And here's the analyst's conclusion, plain and simple. For an investor who is looking for a 9% annual return, the current price of $143 is just too high. It's not a buy, it's a hold if you already own it, and maybe even a sell. So you're probably asking, okay, then what price would work? This table gives us the answer. To hit that 9% return target over the next 10 years, an investor would need to buy the stock at around $108 per share. That is a long way from today's $143. And that, right there, is the practical takeaway from this whole investigation. Which leaves us with this final thought to chew on. PepsiCo feels safe. Its brands are timeless. But this analysis suggests that overpaying for that feeling of safety, well, that's its own kind of risk. It really forces us to ask the question, at what price does a safe investment become a risky one?